Modeling a moving average process. 4.1.1 Beyond Random Walks, the need for new models. In the previous chapter, we delved into random walk processes, characterizing them by their non-stationarity and the absence of autocorrelation in their first differences. This means that while the series itself might wander unpredictably, the changes from one period to the next are essentially uncorrelated white noise. This simplicity makes random walks a useful baseline, but many real-world time series exhibit more complex patterns. Consider a retail sales series for a particular product. While sales might generally trend upwards or downwards, indicating non-stationarity. Even after removing that trend or differencing the series to achieve stationarity, we often observe persistent patterns. For instance, high sales today might be correlated with high sales yesterday, or perhaps a sudden dip in sales last month still has a lingering effect on current sales. These lingering patterns are known as autocorrelation, where a series is correlated with its own past values. When a time series, particularly after transformations to achieve stationarity, still exhibits significant autocorrelation, models more sophisticated than a simple random walk are required. This is where autoregressive AR, moving average, MA, and autoregressive moving average, ARMA, models come into play. These models are designed to capture and leverage these internal dependencies within a stationary time series, enabling more accurate forecasts. An MA process, specifically, captures the dependence of the current observation on past error terms or shocks. 4.1.2 Understanding the moving average, MA, process. The intuition behind a moving average, MA, process is that the current value of a time series is not directly dependent on its own past values, but rather on past forecast errors or random shocks, also known as innovations. Imagine a company's daily production output. While the overall production target might be stable, unexpected events like a machine breakdown or a sudden surge in raw material delivery, shocks, can cause deviations from the target. The effect of these shocks might not be immediate, but could ripple through subsequent days as the production team adjusts, leading to observed deviations that are a moving average of these past shocks. Mathematically, a moving average process of order code snippet, denoted as MA code snippet, is defined as a linear combination of code snippet past white noise error terms. $YT equals \mu plus \epsilon plus \theta 1 \epsilon 1 plus \theta 2 \epsilon t 2 plus dots plus theta epsilon tq $. Let's break down each component of this equation. Code snippet. This represents the value of the time series at time code snippet. Code snippet. This is the mean of the series. For simplicity, if the series is mean-centered, $mu$ can be 0. Code snippet. This is the white noise error term at time code snippet. White noise implies that these errors are in deep, dently, and identically distributed ID, with a mean of 0 and a constant variance, $sigma $2. They represent unpredictable shocks or innovations to the system. Code snippet. These are the past white noise error terms from code snippet previous time steps. Code snippet. These are the MA parameters, coefficients, that quantify the impact of each past error term on the current value code snippet. The order code snippet determines how many past error terms influence the current observation. An MA1 process, for example, means that the current value depends on the current error and the error from one period ago. The key distinction between an MA model and an AR model, which we will cover in a later chapter, is that AR models describe the current value as a function of its own past values, while MA models describe the current value as a function of past error terms. This subtle difference has profound implications for how their autocorrelation functions, ACF, behave, which is crucial for model identification. 4.1.3 The general workflow for time series model identification. Identifying an appropriate time series model for forecasting is an iterative process. Figure 4.2, conceptual diagram, outlines the general workflow which involves several critical steps to transform raw data into a form suitable for modeling and then to select the best fitting model. Step 1. Gather and visualize data. The first step in any time series analysis is to acquire the relevant data and visually inspect it. This initial exploration helps in understanding trends, seasonality, outliers, and potential issues like missing values. For our running example, we will consider a series of monthly widget sales, $K, in thousands of dollars. Let's start by generating some synthetic data that might resemble real-world sales and then visualize it. Download the code on OnePageCode Substack. This initial code block sets up our environment by importing necessary libraries. We then use Code Snippet to create a synthetic time series that mimics widget sales, $K. We include a base level, a slight upward trend, and random noise to make it somewhat realistic. The data is then wrapped in a code snippet with a code snippet for proper time series handling. Download the code on OnePageCode Substack. This chunk focuses solely on plotting the generated time series. Visual inspection is crucial. It allows us to immediately spot trends, seasonality, or sudden shifts, which are vital clues for subsequent modeling steps. From Figure 4.1, we can observe an upward trend, suggesting that the series might not be stationary. Step 2. Apply transformations if necessary. Many time series models, including MA models, assume that the underlying process is stationary. A stationary process has statistical properties, mean, variance, autocorrelation, that do not change over time. The widget sales data, with its clear upward trend, is likely non-stationary. Common transformations to achieve stationarity include differencing, calculating the difference between consecutive observations, code snippet. This is particularly effective for removing trends and seasonality. For instance, taking the first difference often removes a linear trend. Log transformation, applying a natural logarithm, code snippet, can help stabilize the variance when the variability of the series increases with its level. Seasonal differencing. If seasonality is present, differencing by the seasonal period, e.g., 12 for monthly data with annual seasonality, can remove the seasonal component. For our widget sales data, given the upward trend, first-order differencing is a common starting point. Download the code on OnePageCode Substack. Here, we apply the code snippet method from Pandas to compute the first difference. The code snippet call is essential because the first difference value will be code snippet, as there's no prior observation to subtract from. Visualizing the difference series helps us see if the trend has been removed and if the series now appears more stable around a constant mean. Step 3. Test for stationarity. While visual inspection provides clues, formal statistical tests are necessary to confirm stationarity. The Augmented Dickey-Fuller, ADF, test is a widely used statistical test for unit roots, a characteristic of non-stationary time series. The null hypothesis of the ADF test is that the time series has a unit root, i.e., it is non-stationary. If the PVA LU is below a chosen significance level, e.g., 0.05, we reject the null hypothesis and conclude that the series is stationary. Download the code on OnePageCode Substack. This code block performs the ADF test on both the original and different series. The code snippet function returns several values, with the ADF statistic and p-value being the most important for our conclusion. By comparing the p-value to a significance level, commonly 0.05, we can determine if the series has achieved stationarity. For our synthetic data with a trend, the original series should be non-stationary, and the different series should be stationary. Step 4. Check autocorrelation, ACF and PACF. Once stationarity is confirmed, the next crucial step is to examine the autocorrelation function, ACF, and partial autocorrelation function, PACF, plots. These plots help us identify the order of AR or MA components needed for our model. ACF, autocorrelation function, measures the correlation between a time series and its lag values. For an MA, code snippet, process, the ACF will typically show significant spikes up to lag code snippet and then cut off, become non-significant at lags greater than code snippet. This clear cutoff property is a hallmark of MA processes. PACF, partial autocorrelation function, measures the correlation between a time series and its lag values after removing the effects of intermediate lags. For an MA process, the PACF typically decays gradually. Download T-Code on one PACF Substack. Here, code snippet and code snippet from code snippet are used to visualize the autocorrelation and partial autocorrelation. The code snippet parameter determines how many lags are displayed. By analyzing the patterns in these plots, specifically the significant spikes and how they cut off or decay, we can infer the likely code snippet, AR order, and code snippet, MA order, parameters for an ARMA or ARIMA model. For an MA process, we primarily look for the cutoff in the ACF. 4.1.4 Practical Application: Forecasting Widget Sales. The widget sales example is a classic illustration of where time series forecasting, potentially using MA models, can provide significant business value. By accurately forecasting future sales volume, a company can optimize production, ensure enough products are manufactured to meet demand without incurring excessive inventory holding costs, manage inventory, maintain optimal stock levels, reducing the risk of stockouts or overstocking, resource planning, allocate labor, machinery, and raw materials efficiently, marketing strategy, inform decisions on promotions and advertising spend. Beyond sales forecasting, MA models are also frequently applied in other domains. Financial volatility modeling. While not directly forecasting prices, MA components can be used in models like GRCH to forecast volatility in asset returns, which is crucial for risk management. Sensor noise reduction. In engineering, MA models can filter out random noise from sensor readings, providing a smoother, more accurate signal. Quality control. Monitoring deviations from a target process in manufacturing, where current deviations might be influenced by past corrective actions, error terms. Demand forecasting. In supply chain management, predicting demand for various products or services. 4.1.5 Illustrative example. Simulating an MA1 process. To truly grasp the concept of an MA process and its characteristic ACF behavior, let's simulate a simple MA1 process based on its mathematical definition. Recall that an MA1 process is defined as $YT equals \mu plus \epsilon plus \theta 1 \epsilon $1. We'll set $mu equals $0 for simplicity. Download the code on one PACF Substack. In this code, we first define our MA1 coefficient code snippet and the number of samples. Crucially, we generate code snippet white noise terms because the first value of our code snippet at index 0, representing code snippet, will depend on code snippet, representing code snippet, and code snippet, representing code snippet. Our loop correctly aligns the code snippet and code snippet terms for each code snippet. Download the code on one PACF Substack. This plot shows the time series generated by our MA1 process. Unlike a random walk that tends to drift, a stationary MA series will fluctuate around its mean, which is 0 in this case, as we set $mu equals $0. Download the code on one PACF Substack. This final set of plots is critical F for understanding the MA process. For an MA1 process, the ACF should show a significant spike only at lag 1 and then cut off sharply, become non-significant at lag 2 and beyond. This distinct cutoff at code snippet lags in the ACF is the defining characteristic of an MA code snippet process and is a primary tool for identifying the order of the MA component in real-world data. The PACF, on the other hand, typically shows a more gradual decay for MA processes. This simulation helps solidify the theoretical understanding of the MA process and its autocorrelation behavior. Defining a moving average process. A moving average, MA, process is a fundamental model in time series analysis, particularly useful for capturing short-term dependencies in data where current values are influenced by past unobserved shocks or error terms. Unlike autoregressive AR models, which relate a variable's current value to its own past values, MA models relate the current value to a weighted sum of past forecast errors or innovations. This distinction is crucial for understanding the underlying dynamics a model attempts to capture. The role of error terms. At the heart of an MA process are its error terms, often referred to as shocks or innovations. In real-world scenarios, these error terms represent the unpredictable, random component of the time series at a given point in time. Consider daily sales figures. While general trends and past sales might explain a lot, there are always unobserved factors, a sudden local event, an unexpected supply chain disruption, or even just random consumer behavior that cause the actual sales to deviate from what was perfectly predictable. These unobserved factors are precisely what the error terms represent. In an MA model, it's these past random shocks that have a lingering effect on the current value of the series. For instance, an unusually high positive error in sales yesterday might indicate a one-off surge that continues to subtly influence today's sales, perhaps due to word of mouth or a delayed effect. Conversely, a negative error might represent a temporary setback whose influence persists for a short period. Mathematical representation of an MAQ process. A moving average process of order code snippet, denoted as MAQ, defines the current value of a time series $YT as a linear combination of a constant mean $mu$, the current error term $epsilon, and $Q past error terms $epsilon T2 /dots / TQ. The general mathematical equation for an MAQ process is $YT equals \mu plus \epsilon plus \theta 1 \epsilon 1 plus \theta 2 \epsilon 2 plus \dots plus \theta \epsilon TQ. Here, $YT is the value of the time series at time $T. $mu$ is the constant mean of the time series. $epsilon is the error term, or white noise, at time $T. This is the unpredictable component at the current time. $theta 1, \theta 2, \dots, \theta are the moving average coefficients. These coefficients quantify the impact or weight of each past error term on the current value of $YT. The higher the absolute value of a $theta coefficient, the greater the influence of that particular past error. $Q is the order of the MA process, indicating the number of past error terms that influence the current value. The order code snippet is a critical parameter. It determines the memory of the process in terms of past shocks. An MA1 process remembers only the immediate past error, while an MA2 process remembers the errors from the two most recent periods, and so on. Specific examples: MA1 and MA2. To illustrate, let's look at specific cases. MA1 process. An MA1 process is the simplest form, where the current value depends only on the current error term and the error term from the previous time step. YT równa się mu plus epsilon plus theta 1 epsilon t minus 1. MA2 process. An MA2 process considers the current error term and the error terms from the two previous time steps. $YT equals \mu plus \epsilon plus \theta 1 \epsilon plus \theta 2 \epsilon $2. Assumptions of the error terms. For an MA model to be valid and its coefficients to be estimable using standard methods, the error terms $epsilon are assumed to follow a specific stochastic process known as white noise. This implies several critical characteristics. 1. Zero mean. The expected value of the error term at any given time is zero. $e barra inversa epsilon uguale $0. This means that, on average, The unpredictable shocks do not systematically push the series up or down. 2. Constant variance. The variance of the error term is constant over time, denoted as $\sigma caret 2 epsilon dollar. Dollar var, omvänd snedstreck epsilon, lika med tecken omvänd snedstreck sigma circumflex 2 omvänd snedstreck epsilon dollar. This property, known as homoscedasticity, implies that the magnitude of random shocks does not change systematically over time. 3. Uncorrelated. Error terms at different time points are uncorrelated. $COV \epsilons equals $0 for $T $NEC. This is a crucial assumption, meaning that one random shock does not predict or influence a future random shock. Each error is an independent, unpredictable event. 4. Normally distributed, optional, but common. While not strictly required for an MA process to exist, it is often assumed that the error terms are normally distributed. $epsilon sim in 0 sigma caret 2 epsilon dollar. This assumption is particularly important for statistical inference, e.g., constructing confidence intervals for forecasts. These assumptions ensure that the error terms truly represent random, unpredictable noise, and that any observed patterns in $YT$ are due to the specified MA structure and not properties of the error terms themselves. Inherent stationarity of MA processes. A significant characteristic of MA processes is their inherent stationarity. A time series is considered stationary if its statistical properties, mean, variance, autocorrelation, do not change over time. MA processes are always stationary, provided the coefficients $\theta$ are finite. This is because the process is defined as a finite linear combination of past white noise terms, which themselves are stationary. The impact of any given error term $epsilon diminishes as $k$ increases, as it eventually falls outside the code snippet window of influence. This finite memory property of MA models, driven by a finite number of past error terms, ensures that the process always reverts to its mean and its variance remains constant over time. This simplifies analysis and forecasting compared to non-stationary processes like random walks or some AR processes, which may require differencing to achieve stationarity. Simulating an MA1 process, a numerical example. Let's walk through a simple numerical example to see how an MA1 process evolves over time. Assume we have an MA1 process defined by y równa się mu plus epsilon plus theta 1 epsilon t minus 1. Let's set our parameters. $mu equals $10, mean of the series. $theta 1 equals 50 cents, coefficient for the lagged error term. We'll also need to generate some random error terms, $epsilon dollar. For simplicity, let's pick some values. Time, t, $epsilon dollar epsilon, $1 calculation $t equals 10 plus epsilon plus 0.5 epsilon, $1 YT dollar. 0, assume $y0 equals 10 plus 0 plus 0.5 times $0.10. $120 y1 equals 10 plus 2 plus 0.5 times $0.12. 2 minus 1, $2 y2 equals 10 plus minus 1 plus 0.5 times $2.10. 3 minus $1 y3 equals 10 plus 3 plus 0.5 times minus 1, $12.5. For minus 2, $3 y4 equals 10 plus minus 2 plus 0.5 times $3, $9.5. As you can see, the value of $YT$ at any time depends not only on the current random shock, $epsilon dollar, but also on the previous shock, $epsilon dollar. The $theta $1 coefficient of 0.5 means that half of yesterday's shock carries over to influence today's value. This simple example highlights the short-term dependency structure inherent in MA models, simulating an MA1 process in Python. To better understand how an MA process behaves, let's simulate one using Python. This will allow us to generate a series based on a mathematical definition and visualize its characteristics. Step 1. Import libraries and define parameters. We'll start by importing code snippet for numerical operations and code snippet for plotting. Then, we define the parameters for our MA1 process, the mean code snippet, the MA coefficient code snippet, and the number of time steps code snippet. Download the code on one PACF Substack. Here, code snippet sets the baseline level around which our series will fluctuate. Code snippet dictates how strongly the previous error term influences the current value. A positive code snippet means a positive shock tends to be followed by another positive deviation from a mean, and vice versa. Step 2. Generate white noise error terms. The core of an MA process is the white noise error terms. We generate these using code snippet, ensuring they have a mean of 0 and a constant standard deviation. Download the code on one PACF Substack. The code snippet ensures a mean of 0, and code snippet sets a standard deviation of 1 for our error terms. Code snippet is used to make the simulation results reproducible. Running the code again with the same seed will yield the exact same random numbers. Step 3. Initialize the time series. We need an array to store our simulated code snippet values. The first value of code snippet at code snippet needs special handling because there's no code snippet or code snippet. We typically assume code snippet terms B. For code snippet are 0 or the process started at code snippet. Download the code on one PACF Substack. We create an array code snippet of zeros, which will be populated with our simulated values. For the very first step, code snippet, we assume the preceding error term, code snippet, is 0, effectively making code snippet dependent only on code snippet and code snippet. Step 4. Calculate subsequent values using the MA1 equation. Now, we loop through the rest of the time steps, applying the MA1 equation. $yt equals \mu plus \epsilon plus \theta 1 \epsilon $1. Download the code on one PACF Substack. This loop directly implements the mathematical formula, showing how each code snippet value is constructed from the mean, the current shock code snippet, and the previous shock code snippet weighted by code snippet. Step 5. Visualize the simulated series. Finally, we plot the simulated time series to observe its behavior. Download the code on one PACF Substack. The plot will show a series that fluctuates around its mean, code snippet. The short-term dependencies introduced by code snippet will be visible as a tendency for positive or negative deviations to persist for a short period, then revert towards the mean. For an MA1 process, you might observe that a large positive shock is followed by a positive value due to code snippet, but the effect quickly dies out after one period. If code snippet were negative, a positive shock would tend to be followed by a negative value. This simulation provides a tangible link between the abstract mathematical definition and the actual behavior of an MA time series, illustrating how the code snippet parameter, in this case, code snippet, dictates the short-term memory of the process. For higher code snippet values, the influence of past errors extends further back in time, leading to slightly longer-lasting short-term dependencies in the series appearance. 4.1.1 Identifying the order of a moving average process. Understanding and modeling time series data often involves identifying the underlying process that generates the observations. For moving average MA processes, a critical step is determining its order, denoted as code snippet in an MAQ model. The order code snippet signifies the number of past error or white noise, terms that influence the current observation. Correctly identifying code snippet is crucial for building an accurate and parsimonious MA model for forecasting. This section will guide you through the practical steps and techniques for identifying the order of an MAQ process using statistical tests and time series plots. We will build upon the theoretical definition of an MA process and extend methodologies previously used for random walk processes, demonstrating how to differentiate between various time series behaviors based on their statistical characteristics. Step 1. Data acquisition and initial visualization. The first step in any time series analysis is to load and inspect your data. We'll use a dataset representing code snippet over time. Visualizing the raw data provides initial insights into its behavior, such as trends, seasonality, or sudden shifts. We begin by importing the necessary libraries: code snippet for data manipulation and code snippet for plotting. Download the code on OnePatchCode Substack. Here, we import code snippet to handle our tabular data, code snippet for creating visualizations, and code snippet for numerical operations like differencing. We also bring in code snippet for the Augmented Dickey-Fuller test and code snippet for generating autocorrelation plots from the code snippet library, which are essential tools for time series analysis. Finally, code snippet is included for more robust date handling on plot axes. Next, we load the code snippet file into a pandas data frame and display the first few rows to understand its structure. Download the code on OnePatchCode Substack. The code snippet function reads our dataset into code snippet. Code snippet gives us a quick look at the first 5 entries, confirming the column names and data format. Code snippet provides a summary, including data types and memory usage, which is useful for identifying any parsing issues or missing values. In this case, we expect code snippet to be an object, string, and code snippet to be an integer or float. For time series analysis, it's crucial that our date column is recognized as a datetime object. We convert the code snippet column to the code snippet format and set it as the data frame's index. Download the code on OnePatchCode Substack. By converting the code snippet column to code snippet objects and setting it as the data frame's index, we enable code snippet to perform time-based operations more efficiently. This also prepares our data for plotting with proper time series axis formatting. Now, let's visualize the raw code snippet data. This Initia plot helps us visually identify trends, seasonality, or other patterns that might suggest non-stationarity. Download the code on OnePatchCode Substack. This code block generates a line plot of code snippet over time. We use code snippet and code snippet to ensure that the x-axis labels, dates, are formatted dynamically and are readable, regardless of the time span of the data. Code snippet automatically rotates and aligns the date labels to prevent overlap. From this plot, we can observe if there's an upward or downward trend, indicating non-stationarity. Step 2. Checking for stationarity with the Augmented Dickey-Fuller (ADF) test. Before we can effectively model a time series using MA processes, it's often essential to ensure it is stationary. A stationary time series is one whose statistical properties, mean, variance, autocorrelation, do not change over time. Many time series models, including MA models, assume stationarity. Non-stationary series can lead to spurious regressions and unreliable forecasts. The Augmented Dickey-Fuller (ADF) test is a popular statistical test to check for stationarity. Understanding the ADF test. The ADF test evaluates the null hypothesis that a unit root is present in a time series. The presence of a unit root implies that the series is non-stationary, e.g., a random walk. Null hypothesis $H0 the time series has a unit root and is non-stationary. Alternative hypothesis $H1 the time series does not have a unit root and is stationary. We perform the test and interprets results based on the p-value and the ADF statistic compared to critical values. A small p-value, typically less than 0.05, leads us to reject the null hypothesis, concluding that the series is likely stationary. Let's apply the ADF test to our code snippet data. Download the code on OnePatchCode Substack. The code snippet function returns a tuple containing the ADF statistic, the p-value, the number of lags used, the number of observations used, and critical values at 1%, 5%, and 10% confidence levels. We print these values for interpretation. Interpreting ADF test results programmatically. To make the interpretation more systematic, we can create a simple function that checks the p-value against a significance level, alpha. A common alpha level is 0.05. Download the code on OnePageCode Substack. This code snippet function provides a clear, programmatic way to interpret the ADF test p-value. If the p-value is less than or equal to our chosen code snippet, e.g., 0.05, we reject the null hypothesis, concluding that the series is stationary. Otherwise, we fail to reject the null, indicating non-stationarity. Based on the output, our raw code snippet series is likely non-stationary, which is common for real-world sales data exhibiting trends. Step 3. Achieving stationarity through differencing. If a time series is found to be non-stationary, a common transformation to achieve stationarity is differencing. Differencing involves computing the difference between consecutive observations. This process helps remove trends and seasonality, stabilizing the mean of the series. Why differencing works? Removing trends. If a series has a linear trend, first-order differencing, current value minus previous value, will remove it, resulting in a series that fluctuates around a constant mean. For quadratic trends, second-order differencing the difference series, might be necessary. Removing seasonality. For seasonal patterns, differencing by the seasonal period, e.g., 12 for monthly data with annual seasonality, can remove the seasonal component. For our code snippet data, which likely exhibits a linear trend, first-order differencing is appropriate. Download the code on OnePageCode Substack. The code snippet function calculates the difference between adjacent elements. Since the first value has no preceding value to subtract, the resulting series will have one less observation. We reconstruct it as a panda series, aligning its index correctly with the original series from the second observation onwards. Visualizing the difference series. It's good practice to visualize the difference series to confirm that the trend has been removed and the series appears more stable. Download the code on OnePageCode Substack. This plot should show a series that fluctuates around 0, without a clear upward or downward trend, suggesting that differencing has successfully removed the trend component. Retest. ing stationarity of difference data. After differencing, we should reapply the ADF test to confirm that the series is now stationary. Download the code on OnePageCode Substack. If the p-value for the difference series is now below our significance level, e.g., 0.05, we can confidently conclude that the series is stationary and suitable for MA modeling. Step 4. Identifying MA order, Q, with the autocorrelation function, ACF plot. Once we have a stationary time series, we can use the autocorrelation function, ACF, plot to identify the order code snippet of an MA-Q process. Understanding the ACF for MA processes. The ACF measures the correlation between a time series and its lag versions. For a pure moving average process of order code snippet, MA-Q, the ACF has a unique characteristic. Cutoff behavior. The ACF of an MA-Q process will show significant spikes at lags up to code snippet and then cut off, become non-significant, at lags greater than code snippet. This means that only the first code snippet lagged error terms directly influence the current observation, and thus, only the first code snippet autocorrelations will be statistically significant. This cutoff behavior is a key distinguishing feature of MA processes. In contrast, for an autoregressive AR process, the ACF typically decays exponentially or sinusoidally, rather than cutting off abruptly. The confidence interval, shaded area. The ACF plot typically includes a shaded region around 0, which represents the confidence interval, usually 95% or 99%. Any autocorrelation spike that extends beyond this shaded area is considered statistically significant. A common rule of thumb for calculating the standard error of the sample autocorrelations is $1/ is keyword in dollar, where $& is the number of observations. For a 95% confidence interval, The critical values are approximately $PM2/$. Spikes falling within this shaded region are not significantly different from zero, suggesting no significant correlation at that lag. Let's generate the ACF plot for our differenced stationary code snippet series. Download the code on OnePageCode Substack. The code snippet function from code snippet automatically calculates and plots the autocorrelations. The code snippet parameter specifies how many lags to display, and code snippet determines the confidence level for the shaded region. Interpreting the ACF plot for MAQ order. Examine the ACF plot. 1. Look for significant spikes. Identify the lags where the autocorrelation spikes extend beyond the shaded confidence interval. These indicate statistically significant correlations. 2. Identify the cutoff point. For an MAQ process, you should see significant spikes up to a certain lag code snippet, and then all subsequent spikes should fall within the confidence interval. The lag just before the autocorrelations become non-significant is your estimated code snippet. For example, if the first spike, lag 1, is significant, but all subsequent spikes, lag 2, 3, etc., are within the shaded area, this suggests an MA1 process. If spikes at lag 1 and 2 are significant, but lag 3 and beyond are not, it suggests an MA2 process. Potential pitfalls in ACF interpretation. Interpreting ACF plots is sometimes more of an art than a science, and there can be ambiguities. Small, isolated significant spikes. Sometimes a single spike at a high lag might appear significant after a clear cutoff. This could be due to random chance, type 1 error, or a very minor residual pattern. Generally, focus on the initial clear cutoff. Gradual decay versus abrupt cutoff. While an MA process should have an abrupt cutoff, real-world data might show a somewhat rapid but not perfectly instantaneous decay. Use your judgment, looking for the point where the autocorrelations clearly become indistinguishable from zero. Overlapping AR/MA components. In more complex series, ARIMA models, the ACF might exhibit characteristics of both AR and MA processes, making simple cutoff identification difficult. In such cases, the partial autocorrelation function, PACF, also becomes crucial. Practical considerations and best practices. Other applications of MA models. Moving average models are particularly useful in situations where shocks or errors have a short-lived, direct impact on future observations. Examples include quality control. If a manufacturing process has a momentary hiccup, error, its effect on product quality I persist for a few subsequent items before the process corrects itself. An MA model could capture this short-term memory. Financial returns. While financial returns are often modeled as white noise, an MA component might capture short-term memory related to market microstructures or immediate reactions to news. Inventory management. Errors in demand forecasting, e.g., an unexpected surge in sales, might influence inventory adjustments for a few periods, making an MA model relevant for the error term. Example, what a non-MA ACF looks like. To reinforce the concept of an MA process's ACF, it's helpful to briefly consider what an ACF of a non-MA process, e.g., a pure AR process, might look like. For an autoregressive AR process of order code snippet, ARP, the ACF typically decays exponentially or sinusoidally rather than cutting off. The decay pattern reflects the lingering effect of past observations. The PACF, partial autocorrelation function, for an ARP process, on the other hand, cuts off after lag code snippet. This distinction is fundamental for differentiating between AR and MA components when building more complex ARIMA models. If your ACF shows a gradual decay, it's more indicative of an AR component, prompting you to examine the PACF for a cutoff. Saving plots for reporting. For reports or presentations, it's often useful to save the generated plots. Matplotlib provides a simple way to do this using code snippet. Download the code on OnePageCode Substack. The code snippet parameter controls the resolution of the saved image, and code snippet ensures that all elements of the plot, including labels and titles, are included without cropping. By systematically applying these steps, loading and visualizing data, testing for stationarity, differencing if necessary, and interpreting the ACF plot, you can effectively identify the order of a moving average process, a crucial step in building accurate time series forecasts. Forecasting a moving average process. Forecasting with moving average, MA, models involves applying the theoretical understanding of MA processes to predict future values of a time series. This section will guide you through the practical steps of developing a forecasting strategy for an MAQ process, including preparing your data, implementing a robust rolling forecast mechanism, evaluating model performance, and transforming predictions back to their original scale for business interpretation. Preparing data for forecasting. Train test split. Before we can forecast, we must first split our time series data into training and testing sets. This allows us to train our model on historical data and then evaluate its performance on unseen data, simulating a real-world forecasting scenario. Unlike traditional machine learning, where random splitting is common, time series data requires a sequential split to preserve the temporal order. We will use the difference series code snippet for modeling, as MA models are typically applied to stationary data. The original series code snippet will be used later for inverse transformation and final evaluation. Download the code on OnePageCode Substack. Download the code on OnePageCode Substack. The output confirms our data split. We have 449 observations in our training set and 50 observations in our test set for the difference series. To visually confirm the train test split and understand the period we will be forecasting, let's plot both the original and difference time series, highlighting the training and testing regions. Download the code on OnePageCode Substack. The plots visually confirm that the last 10% of our data, highlighted in red, has been reserved for testing. This period represents the future data that our model has not seen during training. Establishing forecasting baselines. Before diving into complex models, it's crucial to establish simple baseline forecasts. These baselines provide a reference point to determine if our sophisticated MA model offers any significant improvement. If our MA model performs worse than a simple baseline, it suggests that the model is either not appropriate for the data or needs further tuning. Two common simple baselines for time series are: 1. Mean forecast, predicting the mean of all historical data. This assumes the series is stationary around its mean and has no trend or seasonality. 2. Last value forecast, naive forecast predicting the last observed value for all future time steps. This assumes the series is a random walk or has strong persistence. We will integrate these baselines into our rolling forecast function to compare their performance directly against the MA model. Understanding rolling forecasts for MA models. A critical theoretical limitation of a pure moving average, MA, model, specifically MAQ, is its forecast horizon. An MAQ model directly uses the passcode snippet error terms, or white noise shocks, to predict the current value. When forecasting code snippet steps into the future, 4 code snippet steps ahead, the model can incorporate estimated past error terms directly into the forecast. 4 code snippet steps ahead, the model can no longer rely on actual past error terms, as they are unknown for future time steps. In this scenario, the best estimate for future error terms is 0, since they are assumed to be white noise with a mean of 0. Consequently, the forecast for code snippet steps ahead will revert to the mean of the series, or 0 if the series has been differenced and has a mean of 0. This means the forecast becomes flat beyond code snippet steps. This flat forecast beyond code snippet steps is often not practical for real-world applications where forecasts are needed for longer horizons. To overcome this, we employ a strategy called rolling forecasts, also known as expanding window or walk-forward validation. How rolling forecasts work. In a rolling forecast, we simulate the forecasting process over time. For each forecast step, 1. Expand training window. The model is trained on expanding window of historical data, which includes all data points up to the current point in the test set. 2. Make one step ahead forecast. The model makes a prediction for the next single time step. 3. Update training data. This actual observed value from the test set is then added to the training data. 4. Repeat. The process repeats, expanding the training window and making the next one step ahead forecast. This approach ensures that the model always uses the most up-to-date information for its predictions and effectively allows us to generate forecasts for a longer horizon, even with models like PACF that have limited direct forecast capabilities. Let's visualize the concept of an expanding window in a rolling forecast. Download the code on one PACF Substack. The diagram illustrates how the training data continually expands with each new observation, allowing the model to adapt and make sequential one-step-ahead predictions. Designing the code snippet function. We'll create a single, flexible function called code snippet that can implement different forecasting strategies, mean, last \value, and RMA model. This function will encapsulate the rolling window logic. Download the code on one PACF Substack. Step-by-step breakdown of code snippet. Partial. 1. Function signature. Code snippet. The difference data frame. Code snippet. Used for training and testing. Code snippet. The initial number of observations in the training set. Code snippet. The number of steps to predict in each iteration. For a rolling forecast, this is typically code snippet, one step ahead prediction. Code snippet. A string indicating which forecasting strategy to use, mean, last, or MA. Code snippet. A tuple code snippet for the code snippet model, specifically for the MA method. 2. Initialization. Code snippet. An empty list to store all the one-step-ahead forecasts generated during the rolling process. 3. Looping through forecast steps. Code snippet. This is simply the length of our code snippet set. The loop will run code snippet times, generating one prediction per iteration. Code snippet. In each iteration code snippet, we simulate predicting the code snippet th observation using data up to code snippet. 4. Expanding training window. Code snippet. This is the core of the rolling forecast. In the first iteration, code snippet is code snippet, our initial training set. In the second iteration, code snippet, it becomes code snippet, including the first actual value from the test set, and so on. This ensures the model is always trained on all available historical data up to the point of prediction. 5. Baseline implementations. Code snippet. These are straightforward. Calculate the mean, or take the last value of code snippet and append it to code snippet. Implementing the PACF rolling forecast with code snippet. Now, let's complete the code snippet function by adding the code snippet model logic for the MA method. We identified our process as an MA2 in previous sections, so we'll use code snippet. Download the code on one PACF Substack. With the code snippet function complete, we can now execute it for each of our chosen methods, mean, last, and MA. Download the code on one PACF Substack. The code snip. ET now holds the actual difference values and the predictions from each of our 3 forecasting methods. Evaluating forecasts on the difference series. We can now visualize and quantify the performance of our models on the difference series. A common metric for evaluating forecast accuracy is the mean squared error, MSE. Download the code on one PACF Substack. The plot provides a visual comparison. It's often hard to discern clear winners from such plots alone, especially for volatile series. This is where quantitative metrics become essential. Download the code on one PACF Substack. The MSE and RMSE values indicate that the MA2 model 0.6862 MSE, 0.8284 RMSE slightly outperforms both the mean 0.6974 MSE, 0.8351 RMSE, and last value baselines 0.6970 MSE, 0.8349 RMSE on the difference series. While the improvement is marginal, it suggests that the MA2 model is capturing some underlying pattern in the error terms that the simple models miss. RMSE is often preferred over MSE because it is in the same units as the original data, making it easier to interpret, e.g., the typical forecast error is 0.8284 units of different sales. Inverse transformation, reverting to the original scale. The forecasts generated by our MA2 model are for the difference series. For business applications, we need these predictions in the original scale of widget sales. This requires an inverse transformation, which is essential. Y undoes the differencing operation. Recall that differencing is defined as $YT equals YT, YT, $1. To invert this, we can rearrange $YT equals YT plus YT, $1. This means to get the original value at time $T, we add the difference value at time $T to the original value at time $T, $1. This is a cumulative sum operation. Numerical example of inverse differencing. Let's assume we have an original series code snippet and its difference series is code snippet. If we forecast a difference value, say code snippet, to get the original scale prediction, 1, we need a base value from the original series. This is the last known actual value before a forecast period begins. In our code snippet and code snippet split, the code snippet set for code snippet starts at index code snippet. The corresponding original series value immediately preceding this is code snippet. For example, if code snippet is 449, the code snippet set for code snippet starts at code snippet. The corresponding original value needed for inverse transformation is code snippet. 2. First forecast, code snippet. If code snippet, the last known original value, and code snippet, then code snippet. 3. Subsequent forecasts. Each subsequent original prediction is the sum of the previous original prediction, which acts as the new base and the next difference prediction. This is precisely what a cumulative sum does when starting from a base. Code snippet, and so on. Let's implement this for our MA2F. Forecasts. Download the code on one PACF Substack. Download the code on one PACF Substack. The code snippet column now contains our MA2 forecasts, but on the original scale of widget sales. Evaluating forecasts on the original scale. Finally, we visualize and evaluate the MA2 model's performance on the original scale. Mean absolute error, ME, is often preferred for final reporting in business contexts because it is easy to interpret. It represents the average magnitude of the errors in the same units as the original data. Download the code on one PACF Substack. The plot shows how well our MA2 model, red dashed line, tracks the actual widget sales, blue line, in the forecast period. While not perfectly capturing every fluctuation, it provides a reasonable trajectory. Download the code on one PACF Substack. Download the code on one PACF Substack. An ME of 0.7410 means that, on average, our MA2 model's predictions for widget sales were off by approximately 0.74 units. This is a highly interpretable metric for business stakeholders. For example, if widget sales are in thousands of units, this means an average error of 740 widgets. This information can be directly used for inventory planning or production scheduling. Even if the model doesn't perfectly capture every peak and trough, a low ME indicates that the model provides a generally reliable forecast range, which is valuable for setting realistic production targets or understanding potential LS deviations. Incorporating confidence intervals for MA forecasts. In real-world forecasting, it's not enough to just provide a point forecast. Understanding the uncertainty around that forecast is crucial. Confidence intervals provide a range within which the true value is expected to fall with a certain probability, e.g., 95%. Code snippet provides methods to generate these intervals. We'll modify our code snippet logic slightly to also capture the confidence intervals. Since the code snippet function returns a list of point predictions, we'll need a separate loop or a more complex return type to handle intervals. For simplicity and to demonstrate the concept, we'll run a separate loop focusing on the MA model with confidence intervals. Download the code on one PageCode Substack. The plot now includes a shaded region representing the 95% confidence interval. This interval typically widens as you forecast further into the future, reflecting increased uncertainty. For business decisions, this provides a range for expected outcomes, allowing for more robust planning, e.g., we expect sales to be between X and Y, so plan for at least X units of production, but have capacity for Y. Beyond MA, Q broader forecasting strategies and backtesting. While the MAQ model, especially with rolling forecasts, is effective for series driven by past error terms, many real-world time series exhibit more complex behaviors. Autoregressive AR components. If a series' current value depend on its own past values, an ARP component or an ARMA model combining AR and MA will be more appropriate. Seasonality. For series with repeating patterns, e.g., daily, weekly, yearly, seasonal ARIMA, SARIMA, models are necessary. Higher differencing orders. If a single differencing does not achieve stationarity, higher orders of differencing might be needed, leading to ARIMA models. The code snippet class in Code Snippet is a versatile tool that can handle AR, MA, differencing, and seasonality, making it suitable for a wide range of time series. Furthermore, the rolling forecast strategy we implemented is a form of backtesting or walk-forward validation. It rigorously evaluates a model's performance by simulating its actual use in a sequential, iterative manner over historical data. This provides a more reliable assessment of a model's real-world forecasting accuracy compared to a single train test split. For critical applications, sophisticated backtesting frameworks are often employed to evaluate models across various historical periods and market conditions. We've thoroughly explored moving average, MA, processes, understanding their mathematical formulation, how to identify their order using the Autocorrelation Function, ACF, and practical methods for forecasting. This groundwork provides a solid foundation for navigating the broader landscape of time series modeling. Distinguishing MAQ from other processes. To recap, a defining characteristic of a moving average process of order code snippet, denoted as code snippet, is its autocorrelation function, ACF. For an code snippet process, the ACF will exhibit significant spikes at lags code snippet through code snippet, and then abruptly cut off to non-significance for all lags greater than code snippet. This clear cutoff pattern is a powerful diagnostic tool for identifying the order code snippet of an MA model. It reflects the process's dependence on past error terms up to code snippet lags, with no direct linear correlation beyond that point. Consider a financial time series where daily returns might be influenced by a few past, unobservable shocks, errors. If today's return is correlated with yesterday's and the day before shock, but not with shocks from 3 days ago or further, then an encode snippet model might be appropriate. The ACF would show significant correlation at lags 1 and 2, then quickly drop to 0. Introducing autoregressive AR processes. While MA processes model the current value as a linear combination of past error terms, another fundamental type of time series model, the autoregressive AR process models the current value as a linear combination of its own past values and a current error term. An encode snippet process of order code snippet is defined by code snippet, where code snippet is the value at time code snippet. Code snippet is a constant. Code snippet are the autoregressive coefficients, and code snippet is white noise. This means that the current value is directly dependent on its code snippet previous observations. The characteristic ACF of an ARP process. Unlike the clear cutoff in the ACF for an encode snippet process, the ACF of a stationary code snippet process exhibits a different, yet equally distinctive, pattern. For an encode snippet process, the ACF typically decays gradually. This decay can be either exponential or more commonly sinusoidal, oscillating, as it approaches zero. Let's delve into why this decaying and often oscillating pattern occurs. In an encode snippet process, code snippet is directly influenced by code snippet, and so on, up to code snippet. However, code snippet itself is also influenced by code snippet, etc. This creates an indirect, cascading correlation. The correlation between code snippet and code snippet for code snippet isn't zero. Rather, it's a diminishing effect transmitted through the intermediate past values. Imagine a stock price that is strongly influenced by yesterday's price. Yesterday's price was, in turn, strongly influenced by the price 2 days ago, and so on. This chain reaction means that today's price still has some correlation with the price from many days ago, even if that correlation becomes weaker and weaker over time. This continuous, albeit diminishing, influence across many lags prevents the ACF from simply cutting off. The sinusoidal or oscillating pattern within this decay often arises in code snippet processes where the autoregressive coefficients, code snippet, are such that they induce cyclical or alternating dependencies. For instance, if code snippet is positively correlated with code snippet but negatively correlated with code snippet, this can lead to an alternating pattern in the ACF. This characteristic signature of decaying, oscillating correlations is a strong indicator that you are likely dealing with an autoregressive process. We will explore specific examples and visualize these patterns extensively in the next chapter. The role of the partial autocorrelation function, PACF. Given that the ACF of encode snippet process does not cut off abruptly, how do we determine its order code snippet? This is where the partial autocorrelation function, PACF, becomes indispensable. The PACF measures the correlation between code snippet and code snippet after removing the linear dependence of code snippet on all intermediate values code snippet. In essence, it tells us the direct correlation between code snippet and code snippet that is not explained by the correlations at shorter lags. For encode snippet process, the PACF behaves similarly to the ACF of encode snippet process. It will show significant spikes at lags code snippet through code snippet, and then abruptly cut off to non-significance for all lags greater than code snippet. This makes the PACF the primary tool for identifying the order code snippet of encode snippet process, just as the ACF is for encode snippet process. Strategic model identification. The identification of appropriate time series models often begins by examining both the ACF and PACF plots of a stationary series. The general strategy is as follows. If the ACF cuts off abruptly after lag code snippet and the PACF decays gradually, possibly sinusoidally, it suggests encode snippet process. If the PACF cuts off abruptly after lag code snippet and the ACF decays gradually, possibly sinusoidally, it suggests encode snippet process. This systematic approach, visually guided by the ACF and PACF, forms the cornerstone of classical time series model identification. The updated flowchart in Figure 4.12 provides a visual summary of this identification strategy, reinforcing how we choose between MA and AR models based on these plot characteristics. Looking ahead, autoregressive models. With a solid understanding of moving average processes and a conceptual grasp of autoregressive processes and their distinct ACF/PACF signatures, we are now perfectly positioned to delve deeper. The next chapter will focus entirely on autoregressive models, exploring their detailed mathematical properties, practical identification using the PACF, estimation techniques, and forecasting applications. We will build on the foundational concepts introduced here, providing comprehensive examples and equipping you with the tools to effectively model and forecast time series data exhibiting autoregressive behavior. Summary: key concepts in moving average (MA) process modeling. This section consolidates the fundamental concepts and practical methodologies explored in modeling moving average (MA) processes. We've covered the definition of an MA process, methods for identifying its order, the crucial role of data transformations for stationarity, the intricacies of forecasting, and the necessary steps for inverse transforming forecasts back to their original scale. Throughout this chapter, we leveraged powerful Python libraries, such as CodeSnippet for statistical modeling, CodeSnippet for efficient data manipulation, CodeSnippet for numerical operations, and CodeSnippet for insightful data visualization. Understanding the moving average, MA, process. A moving average, MA, process, denoted as MA-Q, models a time series as a linear combination of past white noise, error, terms. Unlike autoregressive, AR, processes that depend on past observed values, MA processes are driven by the unobservable shock or error terms from previous periods. The Q in MA-Q represents the order of the process, indicating how many past error terms influence the current value. The mathematical representation of an MA-Q process $YT is given by $YT equals \mu plus \epsilon plus \theta 1 \epsilon 1 plus \theta 2 \epsilon t 2 plus \theta epsilon tq where $YT is the value of the series at time $T. $mu is the mean of the series. $epsilon is the white noise error term at time $T, assumed to be independent. NTLY, an identically distributed ID with a mean of 0 and constant variance, $sigma caret $2. $theta 1 \theta are the MA coefficients, representing the weights of the past error terms. The core challenge with MA processes lies in the unobservability of the error terms, $epsilon. This characteristic significantly impacts how we identify and forecast these models. Identifying the order, Q, of an MA process. Identifying the order of an MA-Q process is primarily done by examining the autocorrelation function, ACF plot. The theoretical ACF of an MA-Q process exhibits a sharp cutoff after lag Q. This means that the autocorrelations are statistically significant up to lag Q and then drop to 0 or become non-significant for lags greater than Q. This behavior contrasts sharply with AR processes, whose ACF typically decays exponentially or sinusoidally, and whose partial autocorrelation function, PACF, shows a sharp cutoff. For an MA-Q process, the PACF typically exhibits a decaying pattern. Let's illustrate this with a simulated MA-2 process. Download the code on one PACF Substack. In this initial code chunk, we set up our environment and simulate an MA-2 process. We use CodeSnippet from CodeSnippet, which is a powerful tool for creating synthetic time series data based on specified AR and MA parameters. Note the specific way CodeSnippet are passed to CodeSnippet. They need to be prefixed with CodeSnippet to represent the $epsilon term. Down. Load the code on one PACF Substack. After simulating the data, we plot its ACF and PACF. For a true MA-2 process, you would expect the ACF to show significant spikes at lags 1 and 2, and then drop off to non-significant values at lags 3 and beyond. The PACF, on the other hand, typically shows a more gradual decay. This visual analysis is a cornerstone of MA model identification, ensuring stationarity for MA models. Like many time series models, MA models assume that the underlying process is stationary. A stationary process has constant statistical properties over time, meaning its mean, variance, and autocorrelation structure do not change. If a series is non-stationary, statistical inferences made from models fitted to it can be misleading or invalid. Many real-world time series, such as sales figures or stock prices, exhibit non-stationarity, often characterized by trends or seasonality. The most common technique to achieve stationarity is differencing, which involves subtracting the previous observation from the current observation. First-order differencing, CodeSnippet, is often sufficient to remove a linear trend. Download the code on one PACF Substack. Here, we create a non-stationary series that mimics real-world data with a trend. Then, we apply the code snippet method from Pandas to perform first-order differencing. The code snippet is important because differencing introduces a code snippet value at the first position. Download the code on 1PACF. Substack. The plot visually demonstrates the effect of differencing. The original series shows a clear upward trend, indicating non-stationarity. The difference series, however, fluctuates around a constant mean, close to zero, suggesting that it is now stationary. While visual inspection is helpful, formal statistical tests like the Augmented Dickey-Fuller (ADF) test are used to confirm stationarity. Forecasting an MA process and the Q-step limitation. Forecasting with MA models presents a unique challenge due to the unobservable nature of the error terms, $\epsilon$. When forecasting future values, we don't know the future error terms. For an MA/Q model, a direct forecast will only incorporate the actual error terms for the next code snippet steps. Beyond code snippet steps, all past error terms influencing the forecast become zero, as our best estimate for future unobserved errors is zero, causing the forecast to revert to the series mean. This is a critical limitation. An MA/Q model's direct forecasts are only truly dynamic for code snippet steps into the future. For example, an MA1 model can only provide a meaningful direct forecast for one step ahead. For two or more steps ahead, the forecast will simply be the historical mean of the series. To overcome this, rolling forecasts or walk-forward validation are essential. Instead of making a single forecast for many steps into the future, a rolling forecast involves 1. Training the model on historical data set. 2. Forecasting one or a few steps ahead. 3. Adding the actual observed value for that period to the training data. 4. Retraining the model and repeating the process. This approach ensures that the model always uses the most recent available information, including the actual error terms, which would be derived from the actual observed values, thereby providing more robust and accurate long-term forecasts. Let's illustrate the code snippet step limitation and then a simplified rolling forecast. Download the code on 1PACF Substack. We start by simulating a simple MA1 process and splitting it into training and testing sets. Then, we fit in code snippet model with an order of code snippet, which corresponds to an MA1 process with no AR or differencing components. The model summary provides details about the fitted coefficients and model performance. Download the code on 1PACF Substack. Here, we perform a single code snippet call for 5 steps. Observe the output. For an MA1 model, the forecast for code snippet will be dynamic, but for code snippet onwards, the forecast will converge to the estimated mean of the series because all $\epsilon$ where $KQ$ are assumed to be zero. The plot clearly shows this reversion. Download the code on 1PACF Substack. This final code chunk demonstrates a simplified rolling forecast. In each iteration, the code snippet model is retrained on an expanding window of data, code snippet, and a single step ahead forecast is made. The actual observed value from the test set is then added to the code snippet to prepare for the next iteration. This ensures that the model continuously updates its understanding of the series dynamics, leading to more accurate long-term predictions than a static code snippet step forecast. Inverse transformation of forecasts. When a time series is differenced to achieve stationarity before modeling, the forecasts generated by the model will be on the difference scale. To interpret these forecasts and compare them with the original data, they must be inverse transformed back to the original scale. For first-order differencing, the inverse operation is a cumulative sum. If code snippet, then code snippet. To inverse transform a series of difference forecasts, you cumulatively sum them and add the last known value of the original series to anchor the transformation. The importance of reporting forecast errors, e.g., mean squared error, MSE, mean absolute error, ME, on the original data scale cannot be overstated. Errors on a different scale are difficult to interpret in a business context, e.g., our forecast was off by 0.5 units of change. Reporting errors on the original scale, e.g., our sales forecast was off by 10 units, provides actionable insights for stakeholders like production managers or inventory planners. Download the code on one patch code Substack. Here, we set up a scenario where we have forecasts on a different scale. For simplicity, we create code snippet by shifting the code snippet. In a real application, this code snippet would be the direct output from your MA model after it was trained on the difference data. We also identify the last known actual value from the original series, which is crucial for anchoring the inverse transformation. Download the code on one patch code Substack. This is the core of the inverse transformation. We create a temporary series that starts with the code snippet and then appends the code snippet. Applying code snippet to this combined series effectively reconstructs the original scale. We then drop the initial anchor value from the code snippet result to get just the forecasts. Download the code on one patch code Substack. The final plot visually confirms the success of the inverse transformation. The code snippet align with the trend and scale of the code snippet, making them directly comparable and interpretable for practical applications, such as forecasting sales volume for inventory optimization or production planning. This complete workflow, from data preparation to inverse transformation, ensures that the insights derived from MA models are both statistically sound and practically actionable.